Assalamu alaikum. Welcome to lecture 11 of tax. So this is the income tax administration. We have completed the computation part of income tax entirely, and then we studied the various types of income, employment income, self-employment income. Then we finished the partnerships, and then the previous lecture was the national insurance contribution, NIC. So this is the last aspect of your income tax, that is administration, how it is administered. So now, under this lecture, we are going to go through the tax return, information and records an individual must retain, the payment of tax, how do you claim for the tax relief, what is the procedure, the time limit, and enforcement when there's a late submission of a return, whether it's income tax or CGT. Failure to retain the tax records. What happens when you are late to notify a new source of income? Interest on tax that is paid late and repaid. Late payment penalties. Then HMRC compliance checks, initiation of inquiries, cessation of a compliance check, discovery assessment, and penalties for incorrect returns. Then appealing against those assessment, how the disputes are resolution of dispute, HMRC statutory reviews, appeal tribunals, and then we conclude the lecture with the syllabus coverage, summary, and technical articles. So, under income tax, the self-assessment, claim for tax relief, then enforcement, then HMRC compliance checks and appeals against those assessment. So basically the penalties, the claims, the timeline, all those things we'll be covering in this lecture. This is like, with this we finish the entire income tax. So lecture 1 to 11 focuses on income tax. So we all know about the self-assessment system, right? Here the tax is collected. The tax that is collected under the self-assessment system, that means this tax is not deducted at source through the pay system. So here, which taxes comes under self-assessment? There are 4. One is your income tax, one is your class 4 NIC, this I have covered in the previous lecture, and next is CGT, capital gain tax. I have not covered this yet, that's my next lecture will be on this. So this 4 type of taxes, you have to file an annual tax return because they are not settled at source. They will not be collected from you at source. You have to file an annual tax return. So under self-assessment, an individual taxpayer is required in respect of each tax year to complete an annual tax return. When should you calculate this? When should you complete the annual tax return and pay the tax? See, the payment of tax is different compared to the completion of the annual tax return. Your annual tax return should be completed by 31st October, following the end of the tax year, if submitted by a paper tax return. And if it is electronic, it is 31st Jan, following the end of the tax year. This, you can say, is known as your filing date. Okay. 2. You have to calculate your own tax liability. This is the meaning of self-assessment. You are calculating your own tax. Then you settle the tax by the due date. So now the system is called self-assessment. Even though it is self-assessment, remember, taxpayers can still appoint a professional to do this task on behalf of them. But remember, only the taxpayer can sign the tax return and only they have to make the payment. Professional advisors can calculate the tax for you, but they can't sign the tax return on your behalf, nor they can pay the tax. Remember, HMRC will also calculate the tax liability. Okay? But for paper returns, they can only guarantee that this will be done in time for payment to be made by the due date. That means if your tax return is submitted by 31st October, let's say it's a paper return, then only HMRC will calculate the tax liability. If it is electronic, automatically the tax liability will be calculated when you're filing online. Then completion of tax return. Tax return has three elements. One is your basic section, that is form SA 100. This all taxpayers must complete. Then there's a supplementary section. The supplementary section covers specific types of income, like income from employment, self-employment, property, partnership, overseas, and capital gain. Okay. So now your paper returns includes a tax calculation working sheet there. So if the taxpayer is calculating his own tax liability, he can use it. Now, there are returns are issued to all taxpayers who are considered to require one. They would include this: higher and additional rate taxpayer, self-employed person, people with multiple income source, people subject to high income child benefit charge. So the nil rate band for savings and dividend and the payrolling of the benefit means many more people have no further tax liability beyond the pay deduction, and fewer tax returns should be required. So now, in order that returns, okay, and if appropriate, the supplementary, they can be issued by HMRC. New sources of income or gain must be notified within 6 months. Okay, if you are having any new source of income or a gain, you have to notify this within 6 months of the end of the tax year. So for 24-25, it is by 5th October, because from April 5th April, if you count 6 months, it is 5th October. So by 5th October 2025, you have to notify any new source of income. But remember, such notification is not required where there are no capital gain and the whole income tax is deducted at source. So if your whole income tax is deducted at source, now you have any gain, then you don't have to notify. Taxpayer can correct or repair their return. Okay, for correcting also they are giving you time to amend this, because sometimes you can make an error, quite possible, and often it is done. So then in that case, taxpayer can amend their return at any time within the 12th month following the prescribed filing date. What is the filing date? Based on your tax year, whatever is the filing date, 12 months from that you can amend your tax return. So on or before 31st Jan 2027 for 24-25 return. These dates are very important, you have to remember. And HMRC can correct the obvious error on the taxpayer's return within 9 months of the date of receipt. For HMRC, it is 9 months of the date of receipt, and if it's you who is correcting, 12 months from the date of filing date. Now, information and records that a taxpayer must retain are: if a person is conducting a trade or they are into a property letting business, they have to return those records for 5 years after the filing date. So filing date is when? 2026. From 2026, if you take 5 years, it is 31st Jan 2031. And if you have any other record otherwise, you only have to keep it 1 year after the filing date, that is 31st Jan 2027. If the tax return is due but no return is filed, okay, your return is due but you are not filing it, HMRC has the power to issue a determination. That means they can estimate of the self-assessment and the amount of the tax payable. HMRC can do this. So tax due under the determination is payable without appeal. Once it is done by HMRC, you have to give that tax. It is payable. But the determination is superseded when the actual return is filed. If you are giving the actual return, remember the actual return will take power over the determination. Now, payment of tax. So, payments under self-assessment are due by 31st Jan following the end of the tax year, 31st Jan 2026. This includes liabilities for income tax, class 4 NIC and capital gain. These three. So now there is a term known as payment on account, which we will cover in the next section. Some taxpayers, they are required to make payment on account of what? Of your income tax and class 4 NIC. That means you are paying in installment. There are 3 installments. First payment on account will be due. Remember the dates, okay? First payment will be on 31st. This is fixed. Being due 31st and during the tax year. So during the tax year means you are in 24-25. So 31st Jan 2025. Second payment is 31st July 2025. Okay, it's always 31st July after the tax year. And the third payment is your balancing payment. Whatever that is the balance. It is due 31st Jan following the end of the tax year. That means after the tax year. 31st. So 31st Jan 2025, 31st July 2025, 31st Jan 2026. 3 payments. This is the dates you have to remember. Now, so for income tax and class 4, 3 installments. First payment on account due on 31st Jan. Second payment on account due 31st July. Balancing payment due 31st Jan following the end of the tax year, the next year. Now, for capital gain, only 1 installment. But capital gain is also due 31st Jan, okay? If you see. Why 1 installment? There's an asterisk mark next to it. So this, for residential property, a payment on account must be made within 60 days of a completion, that is 2 months. We will cover this in lecture 13. In fact, by lecture 12 onwards, we are doing capital gain tax. So this is for residential property. We are selling residential property. If it's commercial property, then normally 1 installment. This is the exception for it. Otherwise, everything else is 1 installment. But if it's a residential property disposal, it's not 1 installment. We make payment on account. That we will cover in capital gain tax. Now, so first payment on account of income tax and class 4 for the next tax year. If you see it for the next tax year, that is also due on 31st Jan, following the end of the year. So there will be 2 payments in the same date. Any repayment of tax arise under self-assessment are dealt when you are submitting the tax return. Taxpayers will submit their paper return on time, that is by 31st October. See, in your exam, they will give you whether it's a paper return or an electronic return. For both, you have to remember the dates, okay? If it's a paper return, 3 months before the electronic date. Okay, so taxpayers will submit by 31st October. If you are submitting on time, you can ask HMRC to calculate your tax liability. But those who submit electronic, automatically your returns will be calculated. You don't have to tell HMRC to do that. So, for a taxpayer's first year of self-assessment, when you have just started, remember, payment on account will not be required. You can't have payment on account. To calculate payment on account, you need the previous year's balance. And you have just started. So first year, you won't have any balance. Only the balancing payment will be due on 31st Jan following the end of the tax year. You will only have 31st Jan. Because you have to complete 1 whole year. So 31st, okay? Only 1 payment. Now, example 1. So here we have some days and some event. Let us see. 31st Jan 2025. For 24-25, this is your first payment on account. Includes both income and NI, class 4 NIC. Second, 31st July, second payment. 31st October, this is you are submitting the tax return if filing paper return. And 31st Jan, submitting the tax return if filing electronic return. And also this is the date when you are making a final balancing payment. And your CGT payment is also here. Only 1 payment. But if it is residential property, then it will be a balancing payment for CGT also. Next, remember for your next tax year, your first payment on account for next tax year will also be this in this Jan, including income tax and class 4 NIC. Now, payment on account. So the payment on account normally is half of your income tax plus class 4 NIC. You are taking half. That's how you calculate. Due by self-assessment for the previous tax year. You are taking the payment on account based on the previous year's figure. So for 24-25 payment on account, you will be using 23-24 figure. Always 1 year back. No payment on account will be required if either your income tax plus class 4 amount is 1000 or less than that. Okay, amount is less than 1000. Then no payment on account. Or more than 80%. More than 80% of your income tax plus class 4 is deducted at source. Okay, for the preceding year, that means year before. And this is also preceding year before. Anyway, you are calculating, when you are calculating payment on account, you are taking the previous year figure only to calculate for this, when you are paying this year. You understand? So either the amount is 1000, less than 1000, or more than 80% has been deducted as source. Remember, when you're taking the 1000 or more than 80%, it includes both income tax plus class 4 NIC. Do not forget to add the two. Do not add CTT if it's given. Now, you can make a reduced payment on account. What is reduced payment on account? You are making an election that you want to reduce your amount that you are going to pay on account. But there is a condition for this. This you can make, okay, where you are expecting, okay, that your current year is expected to be less than the preceding year amount. You are expecting that the current year amount will be less than the previous year. The payment on account. So in this case, if you are making a reduced payment on account, remember the payment on account will be based on the current, not the previous year now. This is only when you are making a reduced payment on account. Normally, we base it on the previous year. But if it's a reduced, it will be based on the current. Care should be taken not to reduce the payment on account too much. Remember, if you reduce the payment on account too much, you have to pay interest on that underpayment. This will be due. So a claim for this basis must be made before the payments are due. Before your payments are due, you have to make this claim that you want to reduce your payment on account. Okay. Now, activity 1. So in activity 1, we'll understand this. A, you have to calculate the balancing payment for the tax year 2025 due on 31st Jan 2026. They have given you the date, because your balancing payment will fall in that date only. Now, explain the consequences if your tax was paid under payee was this much for 23-24, and the total tax payable for the tax year 24-25 was expected to be 8,000. Remember the word explain. They didn't say calculate, and here it's calculate. So let us do activity 1. So let us calculate the balancing payment. First, you need your total tax payable, that is 10,500 here. Okay. So total tax payable. Always mention the tax year 10,500. You have to deduct less already paid by payee. It is 5880. So just do the sum function. Let us delete all this. Okay. Now use the sum function and find out. So now you need to find the payment on account. Okay. to find the balancing payment. Remember, what did they told about the balancing payment? See, payment on account is required or not, you have to do two things. One, the amount in the previous year less than 1000 or not. If you see your 23-24, the total tax payable is 9500, not less than 1000. Then check the 80% rule. So 55110 over 9500. You see, what is it? It's 58%. So 58%, that means it's less than 80%. So if it was more than 80% deducted at source, then you don't need payment on account, but this is less than 80%. So either 1000 or less than 80%. So one criteria you have met, now payment on account are required. First, to find the balancing payment, remember, you need your payment on account. Without that, you can't find. Okay. So now let us do that. If you want to find your payment on account, so it is here 9500 and 54110 deduct. So here you have to find half of it. Okay, so 0.5 into 9500 minus 5510. You see, this is your payment on account. You have already taken half. So first payment on account is 1995. Okay, this is payment on account 1. Then this is payment on account 2. What is the due date? 31st Jan 2025, 31st July 2025. These are paid. These two are paid. Okay. So this 4620. Okay. Minus the sum of this two. So this is you have paid, and this is the total tax payable. Now you deduct. Just do the sum function. So your balancing payment is 630. This is due on 31st Jan 2026. But remember, the first installment for the tax year 25-26 is also due on 31st Jan 2025. Okay. So which will be based in this current year. For 25-26, it will be based in 24-25. We have already got this. You see here. We have already done it here. This. So you have to take half of this. So this also will be due on this date, the first payment on account. So this is with this balancing payment, first payment on account, 2310. So if you add this and this, the total payment 31st Jan 2026. What is the question? Calculate the balancing payment for the tax year 24-25 due on 31st Jan. So total payment that is due is 31st Jan 2026, but balancing payment is only 630. Okay, total payment if they are asking for 31st Jan 2026, it is 2940. But the actual answer is this, because they asked for the balancing payment specifically. They didn't say total payment. If they would have asked total payment, for 31st Jan 2026, answer would be 2940. They just asked balancing payment. So the answer is 613. Now coming to part B. Consequences. If tax deducted 8455. So if it was 8455, you see here, what was the tax in the previous year? 9500. And then what is the tax deducted? 8455. Okay, 8455. So see this in terms of this to find the percentage. If you see, this is 89. You want to convert this to percentage. 89%, more than 80%. So because it's more than 80% means no payment on account is required. You see? Because more than 80% was collected at source. So what should you explain? Remember, you are explaining the consequences. So because you're not making any payment on account, remember this 4620, you are paying all together on one date. That is 31st Jan 2026. Okay. Remember, the overall amount of tax paid will be same whether you are paying on account or not. But the only thing is, if you are not paying on account, you are paying a larger payment on 31st Jan 2026. But if you are making a payment on account, it is divided. You are paying in installments. So you are paying lesser amount, but more frequently you are paying. That is the difference. Now, if your total tax, second part, total tax for 24-25 is 8,000. Okay. So just go, I will go here and change it to 8,000. See what happened. This. So if I want to find this in terms of percentage, equal to 580 divided by 8,000. 73.5. It is less than 80%. So payment on account is required. And the other way is, but you have to calculate the tax. Okay. It's 8,000. Right? And if you see the previous year, it was 9,500. This year, it's 8,000. So current year tax is less than that of the previous. So you can make an election to calculate the payment on account based on the current year, based on the lesser amount. That is on 8,000. Okay. So now when you are making payment on account, it is on this 22120. Okay. So here, this you will divide by 2. This divide by 2. 1060. So this will be your payment on account. So there will be nothing that is left. Why? Because this and this, if you calculate, you will deduct from 2120. So nothing will be remaining. It will be 0, nil. Then we have example 2. So for 2 tax years, income tax is given, tax deducted source is given, class 4 and capital gain tax is also given. So now we have to find the payment on account. Okay. So For 24-25, it will be based on 23-24 figure. Okay. Now, so to find the payment on account, remember the 6,000 of 23-24. Add your class 4 NIC 1,200. This is we are taking 23-24 figure. Okay, the income tax, that is after you deduct the pay from income tax, which is 6,000 and 1,200. So this 6,000 and this 1,200 we will be adding. And we got 7,200. So once you get 7,200, don't take capital gain, only class 4 and income tax, divide by 2. So this is your payment on account, 3,600. Okay. But to find your balancing payment, okay, your total tax payable 2024-25, they have already given you, that is 16,600. From here we will be deducting the two payment on account. Remember the two payments on account. 3,600, so it's 2 minus 7,200. So the sum function 9,400. Then what do you do? Add your first payment on account. So this is your balancing payment that is due. Balancing payment 31st Jan 2026, that is due, BB. Now, first payment on account for 25-26. How do you do that? So we take 8,000 and we take 1,600 plus 4. Now we add 2024-25 figure. Okay, 8,000 plus 1,600 and divide this by 2. Put bracket 4,800. So the first payment on account. This is also due on 31st Jan 2026. So that's why we have to add both of this. Only the first payment on account. So 14,200. Okay, this is the total payment due 31st Jan 2026. The first payment on account of 25-26 and the balancing payment of 31st Jan 2026. Both are payable on the same date. Read the question. They asked. Okay, it's sorry, that's not the question. This is example 2. Okay, so this is your this one. Next, if you want to find the second payment on account, second payment on account will be 31st July 2026. This is for 25-26 we are finding out. So this will be 4,800 first payment. So second payment is 4,800. So this is the answer for activity 1. We have got 630 as the balancing payment. Then the consequences of the alternative. So no payment on account because more than 80% was deducted at source. But the ultimate income tax remains the same, sorry, the amount. The old thing is we are paying more in the final rather than paying on accounts. Then in the second one, there will be payment on account because it's less than 80%. So because the amount was less than the previous year, the current year's tax payable, we are calculating our payment on account based on the current year figure. Okay. Now, example 2, where we have got the payment on account, because we have calculated class 4 and income tax are taken, CGT is not included. Moving on to the second part, that is the claiming of the tax relief. What is the procedure? The procedure is you have to write within a specified time limit that you're eligible for such a relief. Okay, you have to include this in your tax return. Okay, next, for income tax purpose, your claims for capital allowance, okay, personal allowance, reliefs such as gifted donations, contribution into the pension scheme, your losses or repayment, you have to quantify, and it has to be made in the self-assessment tax return. All these things you have to include in your tax return. Remember these points. Okay, then what is the time limit? Unless they are specifying an alternative time limit, all claims are submitted within 4 years of the end of the relevant tax year for both income tax and CGT. So 4 years. Remember that 4 years from the tax year. Now, third area, enforcement. So unless the taxpayer has a reasonable excuse, penalties will automatically apply if a self-assessment tax return is submitted late. Okay, we will cover this in lecture 21 for IHT, inheritance tax. Remember that tax return could be personal or corporate for a company, or even IHT for inheritance tax, which we'll cover in 21. If it is submitted late, penalties will arise. That means your tax return is submitted late under self-assessment, penalties apply. Next, if records are not kept for the appropriate time, penalties, or taxpayer is failing to notify HMRC of any new source of income within the time period. Next, not only penalty, interest also will apply. If you are paying your tax late, interest charge will apply. But if there's a repayment, okay, and interest on that repayment of tax may be added to a repayment made by HMRC. Next, so the rates are given to you in the exam. Okay, the rates to calculate the interest are given in the exam. Unless the personal taxpayer has some reasonable excuse why they are paying late or not notifying, there will be surcharges that will apply to your income tax, to your NIC, and to your CGT balancing payment. And if your CGT still remains unpaid at least 1 month after the filing date for a personal tax return, remember this is for personal tax return. We are in the personal tax return. Next, additional penalties. So additional penalties can arise if your tax remains unpaid because of incorrect tax return. So HMRC will impose penalty as a result of compliance check. They are doing compliance check. They came to know there is a mistake done. Tax return was incorrect, was not given. Penalty, they will impose penalty. And if they come to conclusion that the underpayment of tax was due to the taxpayer not taking reasonable care, or they are deliberately making that misstatement, there's a huge penalty. In fact, at the end of this lecture, there's a table, okay, with the penalty rates and all for the type of mistake. First mistake, when you are submitting or return late, whether it is income tax or CGT. So now, so initially, if a paper or an online return has not been submitted by the filing date, okay, if it's online, then by 31st Jan 2026, a penalty of 100 is imposed. Then After that, additional penalties will apply as follows. So you need to understand this table. Very important is the interval between their filing date. So if it's at least 3 months late from the filing date, that is after 30th April 2026, but not more than 6 months, your penalty is, in addition to the 100, 10 per day. Per day, 10 pounds, starting from 1st of May. This will continue up to 90 days. Next, at least 6 months. That means after 31st July, but not more than 12 months. Then, in addition to the initial penalty, then 10 daily penalty, then higher of 305% of the tax due for the relevant tax year, whichever is higher. Then 12 months or more, that means after 31st Jan 2027, if you are late, in addition to the initial penalty plus the daily charge plus the 5% penalty and a further penalty which is equal to the higher of 305% tax. Then, so remember, significantly higher percentages than 5% can be applied. Okay, if HMRC concludes that the delay is deliberate to avoid tax. Now, failure to retain the tax record, the second mistake. So in this case, maximum penalty is 3,000. So these are the business record. Your annual accounts, including your statement of profit and loss and statement of financial position, your bank statement, cash book, purchase sales ledger, invoices, other records and delivery notes, petty cash book, other relevant business correspondence. Now, when you are late to notify a new source of income, so in this case, late to notify HMRC by which date? By 5 October following the end of the tax year. Then you will attract penalty under the incorrect return rule. This will cover in section 4.4. So whatever is under the incorrect return rule penalty, same penalty for not notifying new source of income, you will attract. Now, interest on tax paid late and repaid. So interest, this prescribed rate will be given to you in your exam. Now, so this interest runs from the day the tax has been paid late. Okay, so from the due date until the actual date of payment, which is of course late. When you are paying the tax in installments, as you have seen previously, okay, the income tax and class 4 NIC and corporation tax for large companies, the rules apply to each payment. Remember, for each payment on account, this interest will apply. So interest, what about repayment? When it's an interest on a repayment of tax, it will run from your original date of payment until the date the repayment order is issued. So here, these are the rates, and this is fixed. Official rate of interest is 2.25. Rate of interest on underpaid tax, that is your repayment. Sorry, official rate of interest is 2.25, but rate of interest on underpaid tax is 7.75. And rate of interest on overpaid tax is 4.25. Now, activity 2. So the balancing payment is 10,000, which is paid on 1st November 2025. Remember this, they have calculated for the tax year 23-24. So you have to see how many months he has been late. When is the filing date? So for 23-24, Part A, state the due date for the payment of the income tax liability for the tax year 23-24. Due date is 31st Jan 2025. But he is paying 1st November. And Part B, state by what date Larry should have filed his self-assessment by 31st Jan 2025. This is the deadline. When is he paying? 1st November. How many months? 9 months late. He is paying 9 months late. So you take 9 months of 10,000 into what? Underpayment tax, which is 7.75. So it is 581. Now, where a taxpayer is claiming to make a reduced payment on account of income tax and class 4. This we have covered in section 1.42. You can go back and check. but a balancing payment still becomes payable. That means you have made a reduced payment on account of income tax and class 4. In spite of that, there is a balancing payment. Then, interest is charged on the understated amounts of the payment on account. For this purpose, the understatement of each payment on account is the difference between. So you have to know what is it. Difference between the actual payment made and the lower of this two. Actual payment on account plus 50% of the balancing payment and amount of the payment on account if no claim for reduced payment has been made. Whichever is lower you take with the actual payment. Find the difference. Okay. Now, so interest on late paid tax is not tax deductible. That means you can't deduct it as an expense from your income or your profit. And interest supplement. If you are receiving an interest on your repayment, it is always tax-free income. That means it is exempt from tax. So now we'll do activity 3, where we are claiming for a reduced payment on account. And you need to calculate the interest that is payable on the account. So in this case, it's Eve required to make payment of income tax for 24-25, which is based on the tax due in 23-24. So 2,800 has been given. Now she expects her income tax liability for 24-25, that is the current year, to be less than the previous year. So he's making a reduced payment on account of 1,750 rather than 2,800, 1,750 each. Both are paid on time. However, the final tax assessment is actually 7,200. Your final tax is more actually. And she pays a balancing payment of 3,700 on this date. So you have to calculate the interest payable, which is interest payable for the payment on accounts. Let us do that. So now the interest will be charged regarding the interim payment. Lower of interim payment made as reduced. So what is the reduced payment? $1,750. Okay. So here reduced So now reduced. When your payment is reduced, it is 1,750. Okay, we have to take the lower. Add 50% final payment. Okay, 50% final payment you have to add. How do you calculate it? Half into okay. Your balancing payment. Okay. So they have given you the final tax payment, which is 7,200. So from here you are going to deduct the two reduced payment on account, which is 2 into 1,750, which is 1,850. So you add both. Remember, this is 50% of the final payment. You have to add with the interim payment made as reduced. Done. And then payment on account if there was no claim that was made, which is 2800, isn't it? Here. So which one is lower, 3600 or 2800? 2800 is lower. So we are going to go by 2800. This is lower. So we are going to choose this. So now when we are calculating interest, it is the difference between the actual payment minus this 2800. So now you have to know how late it is. So now both are paid on time. You have to take 1750 and deduct it from 2800. Now so when is she paying? Now she's paying late, isn't it? So for 2526, now when are payment on accounts due? 1st Jan 2025, right? Thirty-first Jan. So now we'll take payment on account 1. So this is paid. If you see 31st Jan 2026, but you're supposed to pay the first payment on account 31st Jan 2025. So you're 12 months late. Okay. Because that reduced payment you can't make now. You see? If you see the final tax, it's more, 7,200. She was expecting her tax to be less in the current year compared to the previous year, but now it's more. So now her payment, when is it due? 31st Jan 2025. She is paying 31st Jan 2026. The next 31st July 2025. So she's paying 31st Jan 2026, 6 months late in the second payment on account. Balancing payment, no issue. Balancing payment he has paid on time. So now it is 2800. 1750 you have to take. And what is the interest? Underpayment tax 7.75%. So how late you are? This minus this into 1.75. You have been late for 12 months. So if you multiply 12 divided by 12, it's the same. 81. I'm going to always drop down the decimal and give you a number as a whole number. 81 is the interest. Then payment on account 2. For payment on account 2, it is this minus this into this into 6 months. So now the total interest is this 2. 122. So that's the answer for activity 3. Here we have got the lower amount. 3 out of 3,600 and 2,800. Lower amount is 2,800. Actual payment is 1,750. So we take the difference, take the interest rate for the underpaid tax, and you have been 12 months late for payment on account, and payment on 2, you have been late by 6 months. Add both interest, and this is the total interest. Now, late payment penalties. So for balancing payment, now we are moving on to balancing payment. For income tax, NIC and CGT that remain unpaid 30 days after the filing date, these are the late payment penalties. 5% of the tax unpaid. Then a further 5% if the tax is unpaid for more than 6 months after the due date. A further 5% if the tax still remains unpaid more than 12 months after the due date. So first 5% for more than 30, another 5% for more than 6, another 5% for more than 12. Total 15% if you add. Okay. This is penalty. Even interest also will be added with this. Remember, penalty with penalty, interest also will be added. And that interest is calculated from the date it becomes due till the outstanding tax is paid. Now, example 3. So he has been late with a filing date of 31st Jan 2026. So if he is paying 2 March 26, it is more than 30 days. So 5% tax. Next, if he is paying by 31st July, if tax is unpaid, it's more than 6 months, another 5%. And if it's by 31st Jan 2027, tax is unpaid, another 5%. Now, part 4, where HMRC is going to do some compliance check. Yes, they have the power to start the inquiry into the client's tax return. Okay, not only tax return, they can do this inquiry into any claim or election made by the taxpayer. But remember, the proper procedure needs to be followed within the appropriate limits. Now, this inquiry can be just a simple question on a single figure to a full in-depth investigation. Remember, HMRC should not give reason why they have to do the inquiry. They have the power to do it. Now, notice. When should notice be given when they are going to start the inquiry? This must be given within 12 months of the actual submission date. That is, by 31st December 2026 for the return submitted on 31st December 2025. Just take 12 months from that. Or if a return is filed after the due submission date, that means it is filed late, then when do you take the notice for commencing inquiry? The quarter day following the first anniversary of the actual submission date. What are the quarter days? They are 31st Jan, 30th April, 31st July, and 31st October. Remember these quarter days. Okay. Let's say a company is submitting its corporation tax. Okay. For the year ended 31st December 2024 on 31st August 2026. What happened? If you see 31st December 2024 return was due on 31st December 2025, but he's paying 31st October. That means it's late. So because it is late, this inquiry deadline is by 31st October 2027. You have to take the quarter days. What is the quarter days? That means after August. See, quarter day following the first anniversary of the actual submission date. So if you see, being the next quarter, day 1 year after the actual submission date. Okay. So 1 year from the actual submission date you have to take, and the next quarter. So after August, if you see, October is the quarter. After October falls in the quarter day. January, April, July will not fall because they are before August. Okay. So you are submitting when? 31st August. You are submitting 31st August 2026. Take 1 year anniversary, which is 2027. So after August, October is the quarter day, the next quarter day. Now, once a written notice has been given, taxpayer cannot amend the figures until the inquiry is completed. Okay. So provided the action is reasonable for the purpose of checking the tax position of the taxpayer. Assuming that this is important, the HMRC are checking into the client, the taxpayer, because they want to see their tax position. HMRC can request for additional information from the taxpayer or a third party, and this request must be notified in writing and information notice. This has to be given in writing, not verbal. Then, when does this compliance check ends? HMRC has to inform the taxpayer when their inquiry is complete. Okay, and what is the conclusion reached? You have to inform. So, if extra tax is due because of the compliance check, HMRC will amend the self-assessment, or interest will be charged from the date tax should have been paid. Then additional penalties might come under the incorrect return rule. This we will cover in section 4.3, the next section. And if the taxpayer is guilty of making false return, remember it could be your advisor also who is making the return. That's why taxpayer or advisor, if they are guilty of making any false return, then HMRC may seek a criminal prosecution against them. Maybe they might put to prison, or a fine might be taken from them. At the end of the inquiry, the taxpayer might be required to sign a certificate of complete disclosure. There they will say that they have disclosed everything. But if the HMRC later discovers that this declaration was false, that they have disclosed everything, what happens? The individual will be liable to criminal prosecution. They might be even put into prison. Third, the discovery assessment. What is discovery assessment? It's an additional assessment that is raised by HMRC. It is raised by HMRC within 4 years of the end of the tax year. But if it's for companies, then we look at the accounting period. So the time limit, remember, this is 4 years, but this 4 years could be more than 4 years if there is a case of careless behavior by the taxpayer or deliberate concealment or understatement. Then it will be more than 4 years. Now, if the full disclosure has not been made, what happens? Then these are the time limit for your discovery assessment. 4 years if the tax lost was not due to careless or deliberate behavior of the taxpayer. 6 years if the tax loss was due to careless behavior, and 20 years if the tax was lost due to deliberate understatement or concealment of a fraud. So 4, 6, 20. Remember the condition, remember the years. This time limit runs from the end of your accounting period. This is for corporation tax purpose when we are doing company. But for your income tax and CGT, it is the end of the tax year. And for VAT purpose, end of the VAT accounting period. Remember this. Next, penalties for incorrect return. So, for all the type of taxes, a single penalty regime applies. It's not for CGT something else, income tax is something else, corporation tax is something. No, penalty for incorrect return is same for all the type of taxes, including VAT. So, your penalties are based on potential lost revenue. Okay. Remember, there are no penalty If HMRC says that this misdeclaration was a genuine mistake, it's a genuine mistake. Otherwise, size of the penalty depends upon what is the cause of the misdeclaration and the behavior of the taxpayer. This table. See, the maximum is 100 and the minimum is 0. So taxpayer behavior matters a lot with your disclosure. Are you making the disclosure or not? Let's say the taxpayer's behavior is deliberate and concealed. Okay. Maximum is 100. Deliberate but not concealed, 70. Careless, 30. And if you look at the disclosure, okay, if you are making unprompted disclosure, the penalty is less. Unprompted means before HMRC discovers you are disclosing. Prompted means once HMRC comes to know, then you start disclosing. That is known as prompted. So that is the difference between unprompted and prompted disclosure. So for unprompted, penalties are less. And if it's prompted, penalties are more. So this table will help you to understand the penalty for incorrect returns. Okay. Now, this percentages, thank God, will be given to you in your table. Okay. It's there in your tax rates and allowance table, will be provided to you in the exam. If a taxpayer is guilty of making false return, again, fine in imprisonment. Again, they have to sign certificate of complete disclosure. Now, fifth one, appeal against this assessment. Yes, a taxpayer can appeal against any amendment to the self-assessment done by the HMRC, okay, that arise from the HMRC's compliance check. HMRC's right to raise a discovery assessment. Taxpayer can appeal against that also, against discovery assessment also. But appeal cannot be made against the determination of the tax owed. Instead, you have to file the tax return. If you file the tax return, then only it will displace the determination made by the HMRC. And this written notice of appeal has to be given 30 days of the assessment or amendment being issued. And an amendment, an appeal against an amendment made as a part of the compliance check. You are making an appeal because they are amending because of the compliance check. This cannot be heard and determined until notice is given that inquiry is completed. Remember, your inquiry has to be completed, then only you can appeal. While the inquiry is running, in between you can't make the appeal. Okay. Now, resolution of dispute. So once a decision has been made by HMRC, it will notify the taxpayer. Then HMRC will include in the notification whether decision may be appealed or not. If an appeal is made, the original caseworker can consider the appeal in the first instance. If the original decision is upheld, HMRC will normally offer the taxpayer a statutory review. What is the statutory review? This is where your decision will be reviewed by someone else at HMRC who was not involved in the original decision. Another person from HMRC will come and review this. The taxpayer, within 30 days from the receipt of the statutory review offer, either they accept the offer or they appeal directly to an appeal tribunal, known as normally the first tier tribunal. The details you don't have to know. All this first tier tribunal and all these things are there in the under your law. Okay. For your tax, you don't have to know the detail. Now, if HMRC does not receive a response to the offer within the time limits, remember, once you have been given an offer by HMRC, HMRC should receive a response from you for that offer. If not, then it will be treated as settled by agreement. You can only reopen the appeal with the permission of the first tier tribunal. So if the statutory review is not offered by HMRC, Sometimes it might not be offered by HMRC. It's not compulsory. Taxpayer can still request one if it is not. And in your direct tax cases, HMRC might not offer a review. Taxpayer does not even request one. Then, in this case, HMRC does not offer you a review, you do not request, then there is no 30-day deadline for notifying the appeal to the first tier tribunal in that case. And in terms of VAT, remember VAT is not a direct, VAT is an indirect tax. In VAT, HMRC has a statutory obligation to offer a statutory review. When it comes to VAT, HMRC has the obligation. Law says you have to give them a statutory review to the taxpayer. But for other type of taxes, income tax, corporation tax, capital gain tax, inheritance tax, the other 4 type of tax, no such obligation is there, only for VAT. Now, this is the review process. So HMRC, they must state what is their view on this disputed matter within 30 days of the taxpayer's request. If the HMRC has offered the review, then it must state its view of the dispute when making the offer. Number 2, if HMRC has offered the review, taxpayer has to accept this offer in writing, okay, not verbally. That also within 30 days they have to accept. Otherwise, it is taken as HMRC's decision will be taken. Then, that means whatever HMRC has told first, the original view of HMRC will take precedence over taxpayer. Third, HMRC has to conclude the review within 45 days. Fourth, if the review is concluded within the time limit, dispute will be resolved according to the review findings. This may mean your original decision is upheld, reviewer agrees with the taxpayer, original decision is partially upheld. If the review is not completed within the time limit, dispute will be resolved according to the HMRC's original opinion. This you have to understand. And within 30 days of completion of the statutory review, the taxpayer can appeal to the tax tribunal. Remember, they have to wait their 30 days of completion of the HMRC review. Then only they can appeal to the tax tribunal. There are 2 types of tribunal that exist. First tier, second upper tribunal. Mostly everything goes to the first tier. Upper tribunal is for more complex cases, okay? So this appeal to tribunal are split into 4 categories. First, paper track. Paper track are your simple cases. Let's say you are appealing against a fixed penalty. Okay? Normally they are settled by exchanging some documents. Exchange of documents, they are settled. No formal hearing is required for such type of cases. Second, basic track. Here also case might be resolved by just exchanging documents, but a formal hearing is done. Third, standard track. This case is resolved like a basic track, but the procedure is more detailed and formal. And the fourth one is complex track. It is resolved like basic track, but cases are complex, or a case which is involving a large sum of money. Okay. So all appeals to the tribunals are put before a first tier tribunal. Remember, all the appeals first goes through first tier tribunal unless they are complex. If they are complex track, they are referred straight to upper tribunal. If a dispute cannot be resolved by the first tier, then it can be referred to upper tribunal. An appeal to first tier is an appeal before an expert body. Remember, this expert body, they are not equivalent to the code of law. They are just some expert. Before some expert, you are putting your appeal. But an appeal to an upper tribunal is equivalent to higher court. So the president of an upper tribunal is usually a high court judge, and it operates equivalent to high court proceeding. If the taxpayer or HMRC is not content with the opinion of the upper tribunal, they can put their case before the court of appeal. There is no time limit for the length of this appeal procedure to a tribunal. It can take many years. No time limit. As long as you want. So that's it for this lecture. From syllabus, this lecture we have covered section A, that is your UK tax system. Okay, section 3, where we have explained the features of self-assessment system, then the time limit for submission of information, claims and payment of tax, including payment on account. So you have to recognize the time limit for applying to the filing of return and making claims. Then we recognize the due date for the payment of tax and compute payment on account, balancing payment. Then information that a taxpayer needs to retain. Then the procedure relating to compliance check, appeals and dispute. So here, the compliance check. Why might the HMRC impose a compliance check? Then the procedure for dealing with appeals, first and upper tribunal. We have just finished it. And the penalties for non-compliance, late payment interest and penalty. So let us summarize the lecture. Individuals are required to file an annual tax return and settle their tax liability if it's not collected at source. Okay, so this is done by 31st Jan following the end of the tax year. Your tax year ends 5th April 2025. So 31st Jan 2026 is the date you have to file your tax return. Now, payment on account. Payment on account is done for two types of taxes, income tax and class 4 NIC. There are 3 installments. First, payment on account 31st Jan in the tax year. Next, following 31st July. Balancing payment is 31st Jan in the following tax year. And class 2 NIC is no longer out. So this includes CGT. Your balancing payment also includes capital gain tax, unless if it's a residential property, then there's a payment on account. Okay. Under 2 conditions, payment on account are not required. If the relevant amount is less than 1000, or if more than 80% of your income tax and class 4 was deducted at source in the previous year, no payment on account. Then HMRC can issue a determination of tax payable when tax return has not been filed. Tax is payable without appeal. See, your tax has to be paid without appeal, but can be revised after the return is filed. You can revise it after you are filing the return, but you have to file the return. Without it, you can't revise the figure. Next, claims. Claims for tax relief, which are not made in the tax return, have to be submitted by writing in the relevant time limit. Often it is 1 year from the filing due date, but if no earlier time limit is specified, then within 4 years of the end of the tax year. Then, penalties automatically applies for late or incorrect returns and failure to keep records. And then there are penalties for late submission, depending on how late, more than 3 months, 6 months, 12 months. Then interest also runs for late payments from the due date to the actual date of payment. Then there are some surcharges which applies if the amount due remains unpaid for more than 1 month. HMRC has the power to gather data. Then there is a single penalty for all incorrect returns. This penalty depends on the reason for misdeclaration. That means behavior of taxpayer, whether they are careless, whether they deliberately did it, and whether the disclosure was prompted or unprompted. If it's prompted, penalties are more, unprompted penalties are less. That table will help you. HMRC must give a notice of a compliance check into a return. Taxpayer can appeal any self-assessment or a discovery assessment that arises from HMRC's compliance check, but they cannot appeal a determination. Appeal may be settled with the inspector of tax through some informal discussion. If there is no informal resolution is reached, taxpayer can request an HMRC review or appeal directly to a tribunal. Complex cases are heard by upper tier tribunal, other cases first tier. So in this case, there are no technical articles for this lecture. Thank you for watching, and I shall see you in the new lecture 12, with capital gain tax, a new tax. So with this, I finished the income tax. So make sure that you watch my lecture 1 to 11 for the full detail of income tax. And make sure that you practice revision kit questions for income tax. I've finished the income tax portion completely. Thank you, and I shall see you in the next video.